Okay, so we're back from break. So we'll go through some like we've covered some of this before, but we're gonna go deeper into depth today on this topic. So some of it will be overlap though, but more detail. So the functions of money. So money serves three functions. One is a medium of exchange. So it's used to exchange for products and services. That's one of the uses of money. So money is exchanged for products and services. So that's one of the functions. Then it's a store of purchasing power. So it's used to transfer purchasing power from the present to the future. So you have it now, and then so you can use it in the future. That's the key. So $1 Canadian now has the purchasing power of $1, but in the future it will decrease due to inflation. So that's what would happen over time. It would decrease due to inflation. The measure value unit account. So it's something that can be used to value goods and services, record debts, and make calculations. In other words, it's a measurement for value. Imagine trying to do accounting in a barter system. So if you were going to exchange grain for a car, it would be tricky. So that would be tricky. That is why we need currency. So yeah, we need to have currency as an unit, as a medium of exchange, because exchanging grain for a car in that example, it's very tricky. So characteristics of money. Why is the Canadian dollar considered money, but money from the Monopoly game is not? What gives a $20 bill or a $100 checking account entry its value?
Would you like me to answer?
Sure, yeah, go ahead, Alexander.
I think that the validity of each currency is distinguished by the central institution. In our case, it's Canadian Central Bank. So they're establishing the currency that is the official, and this is the one that counts and only can be exchanged. So that's why Monopoly game money cannot be counted, unfortunately. So what gives a $20 bill or $100 checking account entry its value? What does entry its value mean? Like, I just don't understand the second part of the question.
So checking account entry would be a deposit into your checking account.
Okay. So the value that is given by the bank that performs the transaction, as it all goes through the banks, and these are financial institutions that are linked to the central bank but play a role of the intermediate points like CIBC, TD, and so on. So they will establish the value and they will put it through the system and perform the transaction and approve it. Is that the way it
Yeah,
is?
yeah, exactly. That's great. Yeah, it's guaranteed by the bank. So like the bill is guaranteed by the Bank of Canada and the government of Canada. And then the checking account entry is guaranteed by your bank. So like TD, RBC, BMO, Scotia Bank, etc. So yeah, that's great, Alexandra. So that's the benefit of this because it's guaranteed by these parties, and you can trust the Bank of Canada or the government to guarantee it. So that's the benefit. The problem with crypto is that it isn't guaranteed by a government or central bank, which causes issues with the acceptability of from like stores. So like for example, a store would not accept Dogecoin, right? So it's very there's issues with this acceptability. And monopoly money is similar to a lot of cryptocurrencies because many are not accepted, with the exception of Bitcoin and Ethereum. Those two are acceptable by many stores, but the other cryptocurrencies are not widely accepted. So so yeah, the monopoly money situation is similar to what the issue is with crypto, the acceptability. You won't accept monopoly money or a lot of the cryptocurrencies. So yeah, acceptability is a big thing that provides value. That's a big one. Legal tender. So our acceptability is strengthened because the government has designated currency as legal tender. That means that paper currency must be accepted in payment of debt. Relative scarcity, so we have a certain amount of currency available, and there's not too much of it, so the relative scarcity gives its value. Then money derives its value from scarcity, so that's very important. You don't print like limitless amounts of it. That's very important. And then sand could not be used as money because it's everywhere. So sand isn't scarce. Sand is everywhere, and there's no real value because there's too much of it. That the value for money comes from its rareness and scarcity. Sand is not rare or scarce, so it wouldn't work. You need something that's rare or scarce to be valuable. So so I'll ask the class this question. What can you think of that is rare or scarce?
Diamonds, relatively. I mean, there's a lot of people that have diamonds, but they're given value because they're not as common as other gems and stuff.
Yeah, excellent, Ashley. That's great. Yeah. Diamonds for sure. That's a good one. That's a good example. I'll ask, does Kevin want to try?
Um, Gold.
Yes, that's a good one. That's a really good one. Excellent job, Kevin. And then does Hannah want to try?
Those were both of mine that I was going to suggest.
I was also thinking about natural gas and oil because we're running out of them.
That's great. Yeah, natural gas and oil are great examples. Yeah. So any of these could be currency, potentially. But I would say diamonds and gold would probably be good types of currency that you like, things you could exchange, because because of the handling, like you can store these pretty easily. Oil and natural gas, not so much. So yeah, it's funny. I was watching, if anyone watches It's Always Sunny in Philadelphia, they were trying to buy gas and hoarding it just so they make a profit on it. So they were just putting in gas cans. I thought that was really funny. But yeah, doing that would be it would be like putting gas in gas cans from the gas station and then holding it for, let's say, a few years to make a profit. That would be difficult because of storage. So yeah, if you use that as currency, it would be very very inconvenient. So money, it has to be durable also. So to retain its value, perishable items wouldn't serve well as money. So anything that's like perishable, vegetables, etc., they wouldn't be good for being money. So money was portable. Digital money in a bank account can be instantly transferred to buy goods and pay financial obligations. That's a good reason. And then divisible. So money should be capable of being divided into smaller units to enable it for purchase both high and low price commodities. So if animals were used as money, that would be very difficult because you can't really divide it. So that would be a big problem for animals being used as money. And then it needs to be accepted by everyone. So that's a big point here. This is why a lot of smaller countries use the US dollar, because if they had their own currency, it is unlikely it would be accepted, because people don't know it's likely due to the small due to the size of the country. So that's why a lot of smaller countries use the US dollar, because of acceptability. They use the US dollar because of acceptability. So that's a big reason why they use the US dollar. So acceptability is very important to them. So I'll post this in the chat. And then without this, an object is not money, no matter how much it scores in terms of the other characteristics. So no acceptability. Like if the money is not acceptable, everything else doesn't matter. So acceptability comes first above all else. And so yeah, acceptability is first. You need acceptability, or the currency doesn't work. So if no one accepts your currency is basically worthless. So that's a big point here. So I'll just put this in the chat here. So playing cards is money. So playing cards were used as money in Canada when they didn't have gold and silver coins. So why use playing cards? Are rigid, made of stiffer cardstock and perfect for the rigors of circulation. The backs are blank, can writing a value, and so you can put values on it. And also the cards were cut into different shapes for different values. So so that could work, but I'll ask the class, what are the issues that could arise from this playing card currency?
I think that as soon as you give the ability for everyone to do it, they can falsify and write any value on the card. So everyone will have super high amount of money on the cards, and then it will lead to hyperinflation and then recession, and just will be economical crisis because the price of goods will just go over the roof.
Yes, that's great, Alexandra. Yeah, exactly. So counterfeit problems would happen 100%. So that would be a big issue. They would have to have a lot of counterfeit protections with it, like with holograms under the money. Counterfeit protections would have to come into place. And then I liked how you brought up the hyperinflation argument. That was really good, because if this happened on a wide scale, which it would 100%, because trading cards are pretty easy to find, playing cards are pretty easy to find, there would be massive inflation. So that was a good connection there. So then, yeah, so great job on that. Are there any other issues that would arise in this case? Does Juan want to try?
I will think like I don't think it's gonna be accepted in a lot of places. Like it can only be accepted in a region of Ontario, for example. And you go somewhere else, not gonna be accepted.
Yes, yeah, that's a good point. Yeah, that was a great point, Juan. So acceptability, yeah, acceptability may be a
And
problem.
and the fact that it's not regulated and it can change prices a lot, and there's no regulation, inflation and deflation.
Yeah, they can write a new value. Yeah, they
Another
can write a
thing
new
I'm
value
thinking
on
of
it.
is like, is there any sort of, is it just any sort of playing card, or is there specific ones that it was, like a specific ones that were used, or could you buy any sort of like use any sort of deck of cards that you had at home as, money at the time?
So good question. I believe it would be the 52 playing cards used for like those types of card games, but let's look this like I believe it's I'm just gonna bring up the Bank of Canada website here and then just share it. I believe it's the playing cards though from, so let's, so I'll bring this up just so yeah, it is playing cards, so I'll share this. So the playing cards were used as emergency money, and so yeah, like jacks, spades, etc., those types of ones. And yeah, so I'll share the video in the chat, the link in the chat, but yeah, it's the playing cards. Yeah, but also I'll send you this too. So we want to hear from you. Do you have an idea for blog posts you'd like to see? Send it our way. So I'll so yeah, the link to that email here, what I'll do is I'll send you the
Oh.
email. If you do think of any types of blog posts that you want, that you were interested in, or you could write one for them, send it. So here,
I also was going
that's,
to say that in prisons, a lot of times prisoners use cigarettes, I think, as their quote unquote currency. So you can probably draw a parallel with microenvironment and different type of currency there, but it's harder to obtain them there for them for sure.
yes. Can you say that again? What which thing?
In prison, I know that a lot of times people use cigarettes as currency. So in microenvironment, you can draw a parallel of cards and cigarettes.
Yes, that's a good point. Yeah, cigarettes would be their currency there. And yeah, so yeah, great point, Alexandra. So here, I posted the link here. If you have any, if you have something you want to write, you can send it to the Bank of Canada and they may post it. Also, it could be potentially a good opportunity to network with the Bank of Canada. So so yeah, just send anything that you think, yeah, you could send it there. That's a good opportunity for networking. But yeah, there's that link. Bring back the presentation here. So deposit takers. So now that we've defined the functions money serves, let's examine the system in which it operates as well as supply of money. So supply of money is closely associated with institutions known as deposit takers, who accept funds provided by savers and lend these funds to borrowers and hold cash reserves to meet the needs of depositors withdrawing funds. It's the Canadian financial system. The four traditional pillars of the Canadian financial system were charter banks. Excuse me. So charter banks include BMO, TD, RBC, Scotiabank, CIBC, etc. So those ones specifically. So like most chartered banks are insured by the CDIC, the Canadian Deposit Insurance Corporation. So you are insured up to $100,000 in deposits. Always check to see if they are CDIC insured and follow up with the government of Canada to determine if they were telling the truth and not lying, because some banks and financial companies lie about being CDIC certified. So this did happen. This happened in the US with their deposit insurance corporation. So Voyager Digital said they had FDIC, so Federal Deposit Insurance Corporation certification, even though it was false, and people lost all of their deposits. So always verify. So yeah, always verify. So that's very important. And then trust companies. Trust companies, not all of them are CDIC insured. So that's a risk for your deposits, where you can lose all your deposits if the company goes under. Insurance companies, they specialize mostly in insurance, Manulife, Sun Life, etc. Investment dealers. So those are the four pillars. So I'll snapshot this for everyone. So financial deregulation allowed institutions in each pillar to perform a wider range of functions. So while 80 chartered banks operate in Canada, 6 big banks dominate the sector: RBC, TD, Canada Trust Bank, Scotiabank, BMO, CIBC, and the National Bank of Canada. So TD and Canada Trust are the same thing. But now companies like Manulife are going into the banking system. They have a bank now. And then Canadian Tire has a bank now too. So many insurance companies are expanding into banking. So that is happening. So like always check if they are CDIC insured. So that's very important. So always check that, just to protect your money if they go bankrupt. So that's a very important key there. So I'll put some chat here too. So charter banks and near banks. So charter banks are deposit takers allowed by charter to offer a wide range of financial services. Near banks are deposit takers that are not chartered and have more specialized services. They include trust companies, mortgage loan companies, credit unions, and Caisse Populaires. So this is the breakdown of the assets. So RBC has the most in this time period, 2013. TD has the second most. It's very similar now. They're both very close to each other, but but they're now in the trillions. They're over a trillion now. So TD and RBC are the biggest still. Scotiabank is third, which is similar to now. BMO's fourth, which is similar to now. CIBC is fifth, which is similar to now. National's sixth, which is similar to now too. Other domestic banks, very small. Trust and mortgage and loan companies, Casa credit unions, Casa Popular is 305 billion. So my recommendation, putting your money into these here, best choices in terms of their safe structure and CDIC insurance. So best choices to deposit your money due to the high safety of these companies. So they follow a lot of the key regulations that you need to follow. So they're very safe. They're very safe to put your money into. And also investing in RBC, TD, BMO, Scotiabank, and CIBC are good investments. So I am an investor in RBC, TD, and BMO. Very good investments. Yeah, so they're very good investments, and very good deposit places. So yeah, they're very good investments and very good deposit places. So the big six chartered banks hold the lion's share of Canadian chartered bank assets, which include funds given out as loans as well as other forms of financial holdings. Their combined assets are over 10 times those of Canadian near banks. So components of money supply. The total stock of money circulating in the economy is the money supply. What constitutes money? So currency is part of money, and demand deposits. So they're funds that you get immediate access. So you can just take it out of your bank at any time. You can withdraw it at any time. Other components include notice deposits. So you need a notice to withdraw a notice deposit. Term deposits, you have no access for a fixed period. Foreign currency deposits are funds held by Canadian residents that are valued in foreign currency. So money defined. There are 4 common definitions of money in Canada. M1 plus includes currency outside banks, publicly held demand deposits at charter banks, and checkable notice deposits at charter banks and near banks. M2 consists of M1 plus notice deposits and personal term deposits at charter banks. M3 consists of M2 plus non-personal term deposits and foreign currency deposits at charter banks. M2 plus consists of M2 plus corresponding deposits in near banks and some other liquid assets. So the most liquid is M1 plus, and then the least liquid is M3. So this is a graph showing M1 plus, M2, M3, M2 plus. So in this case, M1 plus is the smallest. So demand and checkable notice deposits make up approximately 90% of M1 plus, while charter bank and non-checkable notice and personal term deposits make up almost half of M2. These deposits are less dominant in M3. M2 plus includes deposits made in near banks as well as other liquid assets, as well as similar deposits made in charter banks. So question what are a form of deposits held in banks that are available by making a cash withdrawal or writing a check?
Would it be savings deposits?
Close, it'll be demand deposits. So you could try, Ashley. So demand deposits are demand deposits you can withdraw anytime. Savings deposits, you may need notice to withdraw. Yeah, so good try. And then these require the depositor to commit to leaving their funds in the bank for a certain period of time in exchange for a higher rate of interest, and what are also called what?
Will it be bonds and term deposits?
Close. It'll be certificates of deposit, time deposits. So certificates of deposits require the depositor to commit to leaving their funds in the bank for a certain period of time in exchange for high rate of interest, are also called time deposits. A good try. And then if Roger deposits $240 cash into his checking account at a commercial bank, has the money supply changed?
If it is in checking account, it's still M1, so technically not.
Yes, good job, Alexandra. So great answer there. Yeah, it's still an M1, so it hasn't changed. If it goes to like M2 or M3 and then gets loaned out by the bank, then the money supply can change. But if it's just like a cash deposit that won't be lent out by the bank, it doesn't change. So good job on that. But if later on Roger transfers this $240 from his checking account to a savings account in the same bank, has M1 plus changed? Has M2?
His M2 has increased, so overall circulation has decreased. But I may be-
Yes. Good job. Excellent. So yeah, M1 plus is less, circulation is less. Then yeah, that's great. And then here, so here, what would be so I think to make it easier, what I'll do is I'm gonna just I'm just gonna pause it for a second. I'll bring up the equations for these. So bring up these equations and then I'll ask the class to calculate this. So I'm just gonna give me 1 second. Okay, so I'll get this up here. So here, the to calculate M1 plus, it's coins, notes, and demand deposits. To calculate M2, it's M1 plus notice of personal term deposits. Then to calculate M3, it's M2 plus certificates of deposit, non-personal. So what are the values of M1 plus, M2, and M3 in this case?
So M1 plus will be 13 plus 27 plus 137, which will be 40 plus 137. It will be 177.
Excellent.
M2 will be M1 plus and notice and personal deposit. So it will be 177 plus 215, which equals, sorry, just a second, 392.
Excellent.
And then M2 plus certificates of deposits will equal M3, and it will be 392 plus 72, which will be 464.
Alex, you need to check your math on M1.
Okay. 40
13 plus 27 plus 72 is not 177, it's 112.
No, plus 137, I meant. 40 plus 137. No? Oh, demand deposits. Okay, I accidentally took the wrong number for it. So it will be 40 plus 72, which will be 112. Thank you, Ashley. Sorry. I accidentally took the wrong number.
No problem. I just saw your number and I was like, wait a minute.
Yeah, great job, great job. M1 plus was great. M3 plus and M3 was great. Great teamwork there. M2 is 327.
It's because my M1 wasn't correct and I automatically summed it up with for M2. So that's why the number is a little different.
Oh yeah, makes sense. Thanks for clarification. So great work. Then 327. Great work on that. That was great. So that's how you get M1 plus M2 and M3. So yeah, great job on that. I'll just send this over chat here. So if any of you work in finance, like you could even if you had an interest in finance, you could even do like there are science, like there's a lot of people that are in science that from sciences in finance, if that was of interest to you, having a sciences background and then applying it to finance, it's a good potential opportunity. Yeah, so like these types of skills here would be useful for that. So some economists believe that M1 plus is the most accurate definition of the money supply. I would agree, because you can the benefit of using M1 plus is because you can pay for anything like immediately with it. So if it's cash, buy something right now. If it's in your checking account, you can transfer it to buy something immediately using your debit card. So it's pretty quick. Like it is money. It is the same thing as money. It's just you can buy anything with it right now. There's no like 3-day waiting period or anything. So that's a great thing about it. Other economists prefer M2 plus, especially because of recent innovations in payment methods. So I think it would work if you can use any of the money in M2 plus immediately to pay for things. So that could work, but if you have to wait a few days for it, then it wouldn't really meet the money definition, because it's just too much of a too much of a lag. So credit cards make it more convenient for purchasers to use the credit card company's deposits for payments purposes by borrowing funds for short periods. Their usage does not increase the money supply. Debit cards add to the convenience of using your own bank deposits for payment purposes by allowing funds to be instantly moved electronically. So simple model of the money market. We're going to learn a simple model of the money market. So the money market is a cornerstone of the monetary policy. Like in any market, for important elements: equilibrium price, equilibrium quantity, supply and demands. Supply, for simplicity's sake, we consider the M1 plus definition of money. Demand, asset demand, transaction demands. So the interaction determines the price of money. What exactly is the price of money? Interest rate. So the opportunity cost of holding money is the interest rate. So it's what's sacrificed when you hold M1 plus rather than investing it and earning interest, e.g. a bond. So that's something you got to really consider. You got to really think about this. Like the whole message of that is don't hold cash. Invest in something. So like, yeah, so because you're not making interest right now. So like if you hold cash, you are not earning interest. Invest in something to earn interest. And that's why I showed you Warren Buffett's investing methods, because that is a great framework to earn interest. So yeah, so that those methods are great frameworks to earn interest. So money demand. go through that here. So there are two types of money demands. Transactions demand is related to money's use as a means of exchange to make transactions and varies directly with real output in the price level. Asset demand is related to money's use as a store of purchasing power and is inversely related to the nominal interest rate. So money demand and money supply. Money demand represents the amounts of money demanded for both transactions and asset demand purposes at all possible interest rates. So it's provided with a curve or schedule. Money supply is a set amount determined by government decision makers. It's shown as a schedule or curve. So in this case, demand is downward sloping like this, and there's a greater amount of money demanded at lower interest rates. So as an interest rate change happens, it causes a change in the asset demand for money. So it's a movement along the money demand curve. So a rise in the interest rate causes a decrease in the quantity of money demanded. So it's similar to just supply and demand. So decrease in real output, an increase in real output or price level causes money demand to increase at all interest rates, as shown by the shift from DM0 to DM1. So the supply of money, because government policymakers determine the supply of money at any given time, the money supply curve is a vertical line at that amount. So any change in the money supply results in a shift of the vertical line by the shift of SM0 to SM1. So equilibrium in the money market. So equilibrium in the money market occurs at the intersection of money demand and money supply curves. The equilibrium interest rate is inversely related to the money supply. So goldsmiths is bankers. So as more goldsmiths began to issue these receipts, so how this worked was you have gold as currency. Then you want to store gold somewhere. So you store your gold with a blacksmith. So like, oh wait, so it would be goldsmith. So you store your gold with the goldsmith. They give you a receipt for to show how much gold you stored with the goldsmith. Then you show the receipt when you want the gold back from the goldsmith. So that's what you would do there. And the receipt was the first introduction of paper money. Then then the US government got rid of the gold standard, and it was just the paper receipts now as cash currency. There was no gold backing the currency anymore. So that's how we're just using paper now, because it used to be a receipt that you used to get your gold back. So it was more practical to use the paper receipts because gold is very scarce. So that's how the banking system worked back then, that you gave your gold to the goldsmith. The goldsmith was the original banker. So the goldsmith was the original banker. So you stored your gold with the goldsmith. They gave you a paper receipt, and then you gave the paper receipt back to get your gold back. So that's how the banking system worked back then. So this is so yeah, you give them gold coins, and then yeah, you get a receipt. So this is how they show the accounting for that. So goldsmiths quickly realized that not everyone comes to, wants to redeem their gold. Why not lend out gold coins from the safe and charge interest? Next, they began to lend out the receipts for gold. Created when number of receipts is greater than coins in safe. Money is created out of thin air through lending. So this is the goldsmith story, how it all began. It all started with the goldsmith who made coins, bars, and jewelry. One day a friend asked if he could store his valuables in the goldsmith's vault. Eventually the townspeople began to trade the IOUs amongst themselves instead of gold. The goldsmith saw that the townspeople would rarely withdraw the gold from the vault. He realized he could print IOUs for gold that didn't exist without anyone knowing for now. The goldsmith accepted and gave his friend the IOU the way that he had record for the amount of gold sold. The townspeople took it on faith that the IOUs had corresponding gold in their vault. Prices rose slowly and unevenly at first. Over time, the rise of townspeople returned IOUs to the vault, redeeming them for gold. When the goldsmith ran out of gold, his game was up. The townspeople left with IOUs lost everything, as nobody would accept the goldsmith's IOUs, so they learned the huge difference between currency and money. So this did happen. A similar situation here happened with FTX. So it's similar. So I'll put this in the chat. So it's similar. So with FTX, the crypto company, so people deposited billions into FTX. And so they deposit billions in FTX. Sam Bankman-Fried, the CEO, and others took that money from FTX, that took the deposits from FTX and spent it on houses and like houses, trips, and other stuff. Then most of the deposits were gone and couldn't then the most deposits were gone. Then people wanted their deposits back, and there was nothing left. And they lost most of their savings. So similar to the goldsmith story, where all of the gold was gone and people who deposited the gold couldn't get their deposits back. So this is what happened in both cases. Very similar stories. So historical note. So imagine Canadian currency history back when you could buy a coffee with a $5 from Molson's Bank. So imagine walking into a cafe, buying a drink with a bill from Molson's Bank and getting changed in the form of a Bank of Montreal bill. Sounds like product placement gone wild. It's actually the way things used to be in Canada until 1935, when the Bank of Canada became the sole legal issuer of Canadian legal tender. Until that day, many banks and corporations issued their own paper currency, all with their own designs, all promising to redeem a certain amount of gold to the holder of the bill. That's the way it was pretty much everywhere until central banks became into fashion in the 20th century. So that's what happened before 1935, and it seems like it's starting to happen again with crypto. What happened here is happening with crypto until recently, when crypto kind of went out of style. But this is kind of what is happening with what happened with crypto. It's pretty much exactly the same thing. So bank notes. This was the Bank of Montreal note. Yeah, it's definitely it looks more like the US currency, I find. So that's the Bank of Montreal note. And then the Molson's Bank looks it looks a lot like the US currency also, the US dollar. Yeah, so put that in the chat too. And then these slides are under March 30th this week. Yeah. So if you want to check this, it's under March 30th slides. So bank balance sheets. So bank balance sheets include reserves, loans and bonds, and assets. So these are the assets. So the assets are reserves and loans and bonds. Liabilities are deposit liabilities and owner's equity. So that's what the bank balance sheet is. So that's how they so liabilities are basically another name for debt. So liabilities are another name for debt. Correction, owner's equity wouldn't be under liabilities. So correction there, assets minus liabilities equals owner's equity. So that's how you get owner's equity. And as Warren Buffett looks for a company that is priced lower than the owner's equity. So like the total value of their stock, which is called the market capitalization, should be lower than owner's equity to be a cheap investment. So that's a big important application of owner's equity in this case. So let's chat here. So reserves are cash in the vault, deposit at the central bank. Deposit liabilities are personal, corporate, and government checking accounts, saving accounts, and term deposits. And then so what is a bond? So a bond, what is a bond? A bond is an IOU from a company that has borrowed money from an investor. So when a bank buys a bond, it's lending money to the issuer of the bond. So that's what a bond is. So if you buy a bond, you're a lender. You're lending money to the person. That's how bonds work. So like if you buy a bond, you are a lender. If you sell a bond, you are a borrower. Like, oh, correction, if you issue a bond, you are a borrower. So yeah, if you issue a bond, you're a borrower. So money creation. Desired reserves are the minimum cash reserves that deposit takers hold to satisfy anticipated withdrawal demands. Desired reserve ratio equals desired reserves divided by deposits. Reserve ratio equals desired reserves divided by deposits. So based on this ratio, we can figure out a bank is over under reserved. At times, deposit takers find their cash reserves exceed desired levels, so they have excess reserves. Excess reserves equals cash reserves minus desired reserves. For example, a charter bank with deposits of $100 million and desired reserves of $10 million may find itself holding $14 million in actual cash reserves. So because idle cash reserves earn no profit, deposit takers will try to transfer many excess reserves into income producing assets as quickly as possible. So they lend out excess reserves. So they lend out the full amount of excess reserves. So they lend out about $4 million excess to borrowers. So to see how lending out excess reserves creates money, consider an example. For the time being, we'll make two key assumptions. One, the public holds money in the form of deposits and uses only checks for transactions. Two, all deposits are made to one sort of deposit taker, which we'll simply call banks, and all deposits are of one type, which allows checks to be written against them. We'll also assume that the bank's reserve ratio for deposits are 0.10 or 10%. So server A deposits $1,000 at Cabot Bank. As a result, Cabot Bank has new assets and cash deposit liabilities of $1,000. Cabot Bank lends out $900 in excess reserves to borrower X, creating new loan assets and deposit liabilities $900. So the money supply increases by $900. So then borrower X spends $900 loan money she has received, bringing a deposit account to $0. So cash reserves also fall by $900 because borrower X writes a $900 check to saver B, who has an account at Fraser Bank. Cabot X must transfer $900 of its cash reserves to Fraser Bank. So Cabot Bank now has no liability to borrower X, but also has $900 less cash reserves. Cabot is left with $100 in cash reserves, which is desired 10% of its $1,000 in remaining deposit liabilities. So then they saver B deposits $900 from borrower X's purchase in their account at Fraser Bank. The bank's cash assets and deposit liabilities both rise by $900. Then Fraser Bank lends out its $810 in excess for Y. This creates added loan assets and deposit liabilities at $810. Since Board Y's new deposits money, the money supply increased by $810. So then the money multiplier. The money multiplier is the value by which an amount of excess reserves is multiplied to give the maximum change in the money supply. Money multiplier equals 1 divided by the desired reserve ratio. So it shows how much the money supply changes due to deposits. So example, suppose a bank's desired reserves are 10% of deposits, the money multiplier is 10. So what is the money multiplier? It's 10 in this case. So in the money creation process, an initial change in money has a magnified effect on the money supply. The money multiplier is the value by which the initial change is multiplied to give the maximum total change in money supply. So maximum change in money supply equals excess reserves times money multiplier. Suppose that there is a new deposit of cash in the banking system of $100 and the reserve ratio of all banks is 20%. You would do, so the money multiplier in this case would be 5, so it'd be 1 divided by 0.2. Then you do 5 times the excess reserves of $80 to get 400 in this case. So you do excess reserves times money multiplier to get the change in the money supply. So a charter bank is $1 million in deposits and $40,000 in desired reserves. Its excess reserves are initially 0. What is the reserve ratio in this banking system? So what is the reserve ratio in this banking system here?
40,000.
So that's the amount of reserves. So 40,000 is the current cash reserves. But what would be the reserve ratio?
So it will be the ratio of 1 million to 40,000.
Yes, exactly. That's great.
So yeah, and then we'll have. Sorry, my brain is slowly turning off.
Oh
It'll
yeah,
be-
no problem. No problem. Don't worry about it. Yeah, it's don't worry about it. Thanks, Alexandra. That was great. And then if a further $100,000 is deposited by the bank, how much do the bank's desired reserves increase and the bank's excess reserves? Does Olivia want to try or Zachary?
So would it be 40,000 divided by 1.1 million?
Yes, yeah, exactly. So oh, close. So we would take in this case, we take the reserve ratio of 0.04 and we multiply it by the 100,000. But yeah, good try. So 4,000. So the desired reserves would increase by 4,000 and the excess reserves would increase by 96,000 because this money hasn't been lent yet. So that's what would happen. Good job, Olivia. And then what's the money multiplier in this case? Zachary, do you want to try?
Yeah, so I think money multiplier is 1 over the reserve ratio, so it would be 1 over 0.04.
Yes.
25.
Excellent. Great job, Zachary. And then, so the excess reserves in this case are 96,000. So how much would the money supply increase?
So that should just be 96,000 times 25,
Yes, excellent job.
and that's 2,400,000.
2 million. What's the other number?
400,000.
Excellent. Great job. Thank you, Zachary. That was great. And thank you, Olivia. That was great. And Alexandra, great work. So excellent work on this. And like I said, this won't be tested on. It's just more it's more showing how money is created. It's like the mechanics of what goes behind money creation. So I posted that in the chat. So the reserve ratio of 4% is found by dividing desired reserves by deposits and multiplying the result by 100. Then the bank's desired reserves increased by $4,000 is found by multiplying the increased deposits by the reserve ratio. Bank's excess reserves increased by $96,000 this is found by subtracting the increase in desired reserves from the total increase in reserves. The bank begins the increase in money supply by lending out the excess reserves of $96,000. The money multiplier equals 1 divided by the reserve ratio, or 25, meaning that the final increase in money supply in the banking system is $2,400,000. Excellent job, all of you. And then suppose the bank with a very conservative 50% desired reserve ratio receives a $1,000 deposit. What is the ripple effect throughout the banking system? So since the money multiplier is 2, up to an additional $1,000 in deposits could be created for a total of $2,000. So yeah, this is a great diagram and showing the growth in the money supply due to so yeah, this is a great diagram showing how the money supply grows due to deposits and lending. So yeah, that's the visual. That's a great visual. So in this case, they took 1,500. They took about $1,500, $1,500 in deposits, and turned it into 1998 of money based on lending. So it went from this to this. So yeah, that's the power of lending. So yeah, that's the power of lending, and it just creates money over and over. So what you've just learned implies that banks can only make new loans after new deposit is received. This isn't quite accurate. So here in real life, the process works in the opposite order. Banks decide how much they want to lend depending on the needs of borrowers and the bank's view of the credit worthiness of borrowers. They make those loans, simultaneously creating deposits and increasing the money supply. They then determine how much of the deposit liabilities they should keep as reserves, or in some countries, the reserve ratio is legally mandated. If they are short reserves, they can borrow another bank's excess or borrow from the central bank, which creates reserves out of thin air. They must pay interest on these borrowings. So these are just important application-based facts for it. So bottom line, central banks do not control the money supply, commercial banks do through their lending decisions. However, central banks control the interest rate. Banks must pay to borrow reserves when they're short. This then determines the minimum rate at which banks can afford to lend to customers. That in turn determines how much lending is done, therefore by how much the money supply increases. So yeah, this I just wanted to go in more depth about the monetary policy in this lecture. I know we've covered it